Jinesh Gopani, Head Equities, Axis AMC, is now joining us. Jinesh, good morning. Thank you so much for taking out time for us. What do you think has acted as a catalyst in the last 1 month for the markets? Do you think it's global cues or domestic triggers like remonetization, numbers, or probably even the budget which has taken the markets higher?
First thing is the flows. The domestic flows have been very, very strong. So even if there was a selling from the FIIs for last 2 to 3 months, I think you saw a good amount of inflows from the domestic mutual funds as well as insurance companies, and whatever selling was there has been taken care by the domestic institutions. So I think that is the first reason. Second is the effect of demonetization and the estimates which are very, very negative in terms of the numbers which were supposed to come for December quarter. I think the numbers have been much better than the expectation. Even as I had said in the earlier interview also in your channel, that the channel checks what we did were not showing that so bad signs of in terms of ground reality than what was being envisaged. So I think the numbers, at least for the listed companies, has been pretty good than the expectation. And third was the expectation from the budget was on LTCG, which could have been a negative for the market, but that has not come through. So it's a big relief, and no other negatives to any of the sectors has been taken positively by the market from the budget point of view. So these are the three factors I would say.
Right. I was talking to a couple of FIIs and they were saying that there is a left out feeling which is there within a lot of FIIs. Do you think that funds that were underweight on India would now come out and buy quite aggressively to get the remaining 4-5% which is remaining probably in this rally?
So I don't know whether they will go and buy out aggressively, but obviously as they have been net sellers for last 2 to 3 months, I think obviously they would be looking into India again. I think especially again after the demonetization thing, people had become very negative about India story, and especially for coming quarter numbers, and that has been completely overchanged. And the numbers have been much better than the expectation. I think FI should again look into India and let's see how they buy. But then whether they will buy aggressively, I don't know.
Right. As far as Q3 results are concerned, do you think it could be a one-off because of very strong festive season plus demonetization, the impact over there, and Q4 probably would give a real picture of spending?
True. So even we want to see how March quarter numbers pan out. But looking at the commentary of the companies, especially now already you are into February, Jan is over. So when you go into the conference call of all these companies, I don't think they have been sounding very cautious on January numbers or for the quarter. So still we'll have to see how the March quarter pans out. But things doesn't look to be so bad as was being envisaged. And also the cash in the system has come back very fast. Urban India is back. Rural India still might be 10-15 days behind urban India. But I think the economy has again started in terms of the cash transactions which you want to have for the SMEs or mid SMEs.
Right. As far as valuations in India is concerned, do you think after the recent rally of 7-8%, now the returns would be moderated? We spoke to you in December, and you said that chances are that in 2017 returns would be positive, but now chances are that returns would be only moderate from here on.
It's difficult to say because again how the flows come by. If next 6 months are heavy flows, then frankly it is difficult to give you a very short-term view whether it will be 4-5% or 10% rally from here on, or it will just be flatten out from here on for next 2-3 months. So very difficult to give you a view, but obviously this rally has been very good, and most of the investors, especially from the FII side, has been surprised by this rally. Hopefully if things come back to normal And I think the more important is, if you see the companies, if they start delivering again 10, 15, 20% growth trajectory, I think it will be more of a stock specific market, and the companies which are delivering will again start showing improvement in returns.
Right. In terms of FY18 results, now that the remonetization pace has been better than expected than what it was at the start of December, do you believe that FY18 numbers may not see a very big downgrade coming in, and that should be taken as a positive?
One should remember that you have GST coming in place. So when it comes, let's say it comes in July, then there would be some kind of a teething issues in terms of the inventory, how to stock up the inventory, what could be the benefit. All systems and processes should be running well. So there could be a disruption maybe for a quarter, because all companies and the supply chain will try to understand how GST will work. So if you take that aside, then obviously numbers should be good. But you have to bear in mind that that could be sort of a 1 quarter or 2 quarter phenomenon, how GST takes the toll on the overall sales numbers.
Right. As far as the overall sectors which can lead the growth is concerned, do you think global linked sectors would do well? Companies that drive more of exports, or do you believe that most of the demand would come back in the system with a lag effect, and that's why consumption names to do well?
So we feel that domestic story is more intact than the let's say export or the global stories. So if you take IT and pharma sector, they have their own headwinds because of various issues they are facing, sector per se, and the way US administration is trying to increase the visa or H1B visa immigration fees, and more noises are coming out which are not in favor of the sector. Having said that, the valuations are better now, and hopefully maybe after 6 months you will see again those sectors starts doing well. But we would like to play more of a domestic story. As you know, if India has to grow at 7 to 8% GDP growth, you need this domestic sectors to grow at 15, 20, 25% to really take up India to the GDP growth levels where they are. And India being a domestic driven economy, I think it is better to play domestic driven stories than heavily being invested into the export stories.
Right. Just before we go into various sectors, any word on mid cap versus large cap valuations? Has it continuously surprised you that mid cap, small caps have been better valued than the large cap names?
I think the flows in mid caps have been very, very strong, especially on the mid cap fund side or the multi cap fund side. And I think that is what is holding on to this kind of valuations. Having said that, even the companies have been delivering much better numbers than the large cap names. This is the normal phenomenon when you have an upward trajectory of GDP growth. You will normally see mid caps doing better than the large caps. However, the valuation gap is slightly higher in mid cap, and I think large caps are more favorable, I would say. But again, we'll have to see how flows determine the Nifty or the mid cap funds indexes.
You see any signs of slowdown into the flows into mid cap space or small cap space?
As of now, looks difficult because as you see, the amount of deposit accretion which has happened in the financial sector, in the banks, I think somewhere some part of the money will get channelized into mutual funds or insurance. And if that continues, and if mutual funds or the insurance company keep on receiving good amount of inflows per month, then I think it would be difficult to say whether mid caps will receive money or no.
Right. Let's talk about the sectors as well. So, financial numbers, especially from the private banks, you think numbers are way better than estimates? Whether you pick up any bank which is focused on the retail side, and that will continue to act as a compounding story?
Yeah, so we have been always been bullish on private sector banks, and especially because the kind of management pedigree they have, the kind of conservatism with which they run the business model, especially on the asset quality side, especially the retail driven private sector banks. So they have been able to navigate this phase very well. The deposit mobilization has been very good for the top 5 private sector banks. The cost of funds have come down. Though the advance growth are in let's say 12 to 13% range, I think it is just a matter of time. Once economy picks up, the advance growth levels can bounce back. Also, when the system credit growth is just 2% for the quarter, growing at 12% or 15% or 20% is a big ask, and that is where the penetration story of public versus private is still continuing. And if you take on the incremental market share, private sector banks are now 55% of the incremental market share what they are garnering in the market. So clear case of evergreen stories with compounding returns.
Right. Just as you told us about incremental market share of 55%, do you think that still the market that these banks are targeting is very large? So a lot of market share can be taken in from a lot of other old banks?
Yeah, so it is every year it is happening, and the way these guys are growing in terms of branches, in terms of digital initiatives, in terms of accessing the customer base, is very, very fast. And unfortunately, public sector banks, because of the asset quality concern, they are more focused towards resolution rather than focusing on tapping the market. And so if there is a freeze for the 70% of the market share, which is current data point, it's a clean run for private sector banks to add new customers, add new cream customers from the public sector entities, and try to grow their market, which is incremental at 55%.
As far as corporate banks are concerned, do you see growth recovering over there? Corporate banks can do well in FY18 because for the last 5-7 years, they've not been doing well. And, loan growth cannot just happen with one sector like retail or any other sector just growing with other sectors not doing well.
See, it will take time. Maybe our hunch is that maybe another 3 to 4 quarters in terms of growth coming back. If you take retail, for them also has been growing pretty well. The problem is on the corporate side, and because of the slow movement in the resolution of the NPAs, I think it is becoming more difficult for them to grow the corporate book, because first of all, there are no big large projects which are coming, which used to come in 2009, 10, 11. And so you have to be very careful while again you are choosing the corporate where you want to lend money. So there are not many projects. There are many projects which are stuck. They are not still off the ground. So there are resolutions. Resolutions are slow. Obviously, the banks have done well in terms of providing them. And so the asset quality, let's say, will peak out maybe in next quarter or quarter after that. And once you have the asset quality picking out, the provisioning levels for the banks will come down over in FY18, which should help in terms of profitability. However, for the core income to start growing, I think it is still maybe 3 to 4 quarters away.
Right. As far as NBFCs are concerned, again, there the market share gain versus PSU, especially in the rural areas, that continues to be one of the big stories.
I think it is more of tapping the underbanked market. So if you see, the NBFCs normally operate in a region where mostly in the region where banks are not present, or they are thinly present, I would say. So again, maybe the public sector banks would be present in those areas, but maybe they might not be doing retail lending in a big way how these guys are doing. So obviously again market share game plus underbank regions where these NBFCs are very good. So we concentrate only on very niche NBFCs who have grown without hurting their asset quality, and there are good place to play. The good part for them has been the cost of funding has been continuously coming down in last 12 months, which has helped them in sustaining the margins and as well as improvement in the asset quality. The growth is there because let's say during demonetization, the entire banking system was more concentrating on deposit mobilization. NBFC were able to grow because they don't have to go for this deposit mobilization, and because of the deposit mobilization, the cost of funding came down for them because they borrow from the banks. So that has all helped them. And if you see the numbers again, and as it was envisaged, the numbers might be bad, numbers have been much better than the expectation.
Right. Just a word as far as consumption sector is concerned. So, we've got results from Havells, Crompton Consumers, Blue Star, some of the other consumption durable companies. Not taking any specific names, do you think numbers there were much better than expected in terms of, the overall sales that the company has done, the commentary that the company has given versus initial thoughts after demonetization?
I think the earlier expectation was that it would take, let's say, 2 quarters for entire remonetization to happen and things will be very, very slow. But as you see, by Jan, most of the things are back. Urban, as I said, is already back. Rural is coming back. Maybe by Feb end or March, you will see rural also back in terms of cash transactions and which had stopped. So numbers have been much better, as I said, has been much better than the estimate because people had become very negative about entire episode of demonetization because we don't have the precedent, so we were not aware of what will happen. But fortunately, since there is no wealth destruction and most of the money has come into the banking system, things doesn't seem that the consumption is just falling off the cliff, or there are no weddings happening or anything like that.
Right. In terms of, consumption sector, so initially there was a decline in the consumer durable names after demonetization with the fears that you just pointed out. But now do you believe that, again, consumption sector has come back in terms of valuations? So returns will be moderated from here on, or valuations are not very attractive?
See, valuations are high. And valuations are high predominantly due to the opportunity which is available, let's say a 10-year window or a 50-year window for the entire consumption boom to take place. And the cash flows what these companies generate, the kind of brand they have at the marketplace. So valuation, even if you take 5 years back or 10 years back, valuation has always been expensive. However, the valuations are more expensive at this point of time. And if the growth is commensurate with the kind of valuation they are getting, then there shouldn't be any issue. But obviously, if growth is not commensurate with the valuation, then obviously the returns will be moderate.
Right. But as far as consumption sector is concerned, so in the last 5-7 years, the theory has been that consumption are perpetual growing sectors in India, especially if it's a great brand and very well managed. So that continues to be the case and no reason for changing that after demonetization?
So again, with GST coming in, all the organized player or the branded players, and let's say if they are into the sector where 50-60% is unorganized market, those guys will tend to gain disproportionately because now it would be a level playing field rather than fighting out with 100 competitors who might not be paying taxes and trying to grab a regional market share. So I think it's a very good time for this consumption companies, but we'll have to see which company fits when, in which sector, what kind of unorganized segment they run into in their sector, and how they are able to grab that market share. But I think valuations are also high because this is what the thought process has been, that once GST comes in, all these companies will have the benefit of level playing field and they will try to grab more market share given the brand presence what they have.
Right. In terms of airlines, increasingly the thought was that airline is now becoming consumption. It's becoming a part of daily need, and people would tend to pay slightly higher for airline tickets. But with the recent results that we have seen for Indigo, for Jet, do you believe that yield pressure continues despite traffic growth? It tells that it's a cyclical sector.
It is, because I think the competitive intensity is very high for a few peak sectors where you want to fly, and the kind of offers or discounts people are offering, I think it is a cyclical sector, and oil was a tailwind for you in last 12-15 months. Now it is a headwind for you. So again, that pressure will again start mounting for them. So I think it's more of a cyclical sector than a pure consumption story.
Right. As far as pharma is concerned, are you worried what happens into US, how things progress over there, plus the US FDA issue, and that's why pharma could again be slightly under the weather even this year?
So it will depend on case to case basis. You cannot just have the entire pharma industry under problem. But most of the companies have been facing the US FDA issues, be it a large pharma company or be it a API supplier. So I think US FDA, what we are getting to understand, that US FDA has become very, very stringent, and they want world-class facilities now. And because your share in US is gone up significantly, they don't want to take any chances in terms of the CGMP compliances or the standard operating procedures. If you see, the recent 483s has been pretty bad for many companies, and I think once they are able to, it is more of a putting more money and upgrading your standards rather than any product issues. So I think it is just a matter of time, and once companies are able to live up to the standards of US FDA, then I think for them next 2-3 years could be very good.
Jinesh, thank you so much for taking our time for us.